Have you ever felt like you were doing everything right, but your trade still failed? Maybe you caught what looked like a breakout, only for price to snap back. Or you entered a reversal just in time to watch it keep trending. Here's the truth. There are only 3 types of trades that exist: breakouts, pullbacks, and reversals. Although there may be different names for these trades, like the 200 EMA reversal, the New York reversal, the conservative entry after rise level 1, essentially, they fall into these 3 categories. If you don't understand the real story behind each one, you're just gambling. Most traders use patterns or indicators to guess. TBD traders read the market like a book. Hi, my name is Janet and this is Trade Travel Chill. If you're new here, welcome. If you're returning, welcome back. Be sure to hit the like button nice and early for the YouTube algorithm and hit subscribe if you're not already subscribed so that you can be notified every time I upload a new video. Today I'm going to show you how to spot each setup using the TBD system, avoid common traps and fake outs, and how to use structure, vectors, and session timing to build a reliable edge. This isn't just another surface level video, we're diving deep, and by the end you'll finally know which trade type suits your style and how to execute it with confidence. Let's get into it. Breakout trades look exciting, especially when candles start to break through key levels. But in the TBD system, we don't chase red candles or big green candles, we anticipate them. Here's how we approach breakout trades in the TBD system. We usually see a breakout after a long period of consolidation. The longer the range holds, the bigger the breakout. What we want to see next is signs that the market maker has collected enough contracts to build their own position in anticipation of the breakout. Then we look for the vector candles that show intent, not just any move, but one with purpose and backed by volume. What we want to avoid is jumping in on the first big green candle that breaks the high or the first big red candle that breaks the low, or trading levels without context. So how can we get in on a breakout like this before it happens? There are 2 indicators that are going to help you immensely in anticipating the breakout. Those 2 indicators are open interest and volume. You can use the standard volume, however we use the PVSRA. If you don't yet have these 2 indicators, head up to indicators, type in PVSRA, candles auto override by Trade Travel Chill, and the open interest indicator is open interest auto override by Trade Travel Chill. Add both of these to your chart and they will show up down the bottom here. Open interest shows us how many active long and short positions are open in the market. It doesn't tell you the direction, but it does tell you whether traders are getting in, getting out, or just rotating positions. So here's how to read it. If open interest is rising, that means new positions are being opened, momentum is building. If open interest is falling, that means traders are closing out and momentum is dying off. If you see a sharp drop in open interest like this, more than likely traders are being liquidated. If open interest stays the same, positions are just transferring, usually during a flat or indecisive move. With the PVSRA, if the volume bars are red or green, this means there is 200% more volume than the previous 10 candles. And if they are blue or magenta, this means they have 150% more volume than the previous 10 candles. When we see big volume spikes like this, we assume that it is the market maker because retail can't push that much liquidity in one candle. However, you'll see here over the weekend we have vector candles and the market maker isn't on duty. The volume isn't there over the weekend and it isn't going to take much for these candles to start lighting up as vectors because the volume prior to those vector candles is very, very low. However, you can see once the market opens, that volume changes dramatically. So time to put this all together. If price is consolidating or moving sideways and the open interest is rising whilst volume remains low, it often means a breakout is coming and no stop hunt is needed. If price is consolidating, the open interest is decreasing whilst the volume is flat, this often signals that the market maker needs to induce more traders to take a position to create liquidity, often in the form of a stop hunt. So now that we've broken down how to read open interest and volume, let's bring it back to breakouts and why the market maker does what they do. Because this is the part where they start setting the trap, getting retail on the wrong side and loading up liquidity to drive that move. We're going to walk through two types of breakout setups, one that needs a stop hunt and one that doesn't. And by the end, you'll know exactly what to look for so you're not caught reacting late. The model we trade gives us context for these moves. If we understand the pattern, the timing, the level, then we can read whether the market is setting up for a direct breakout or a trap first. We can see that price has been consolidating for an extended period of time, this here being a weekend trap. During the first half of the weekend trap, the open interest is relatively flat as well as the volume. But towards the second half of the weekend, we can see that open interest is starting to increase whilst the volume is still low. When you see price consolidating, open interest increasing and the volume low, this means a breakout is incoming and a stop hunt is not necessary. But let's talk about the why. When price goes into consolidation, people get bored. So when they see fast green candles or fast red candles within the consolidation range, it induces them to take a position. However, if not enough traders have been induced during the consolidation, that's where we can see the spikes out of it that trigger breakout traders. For example, we can see that this is the current high of the weekend trap, and then we've seen a fast spike out of it. There are traders who would have had buy stops above price that trigger them into a long position should price break above that level. And at the same time, this here created a higher low within the range and traders might have been induced to take a position before it even broke out. What that does is build the liquidity below price. At the same time, anyone who had entered a short position during the consolidation with a stop loss above the high, that small move would have triggered their stop losses. But what we really want to know is, did this move actually do the job of what I just explained and induce retail to take a position? So when we look at the open interest, yes, we can see that positions were open, and we're going to assume because price is moving to the upside that long positions were taken here. From there, price then pulls back into the range, and anyone who has opened a long position with a stop loss below the weekend range is still safe. Once the market reopens around Sunday 5 PM New York, market maker assesses the weekend price action to see where the liquidity has built up and whether they need to issue a stop hunt before the reversal. So how do we trade this breakout? This is a weekend example, but the same applies if it was happening during the week. If you see consolidation with low volume and open interest increasing, you can be assured that a stop hunt is not needed. So as soon as you get a lower high with your bearish candlestick pattern, you can feel confident that the breakout is going to happen. The next type of breakout is one where we may see a stop hunt issued before the move actually happens. Here we have a similar example. Price is consolidating, but this time it's a little different. Open interest is decreasing and the volume is relatively flat. Well, it is flat. What this tells us is market maker needs to induce retail to take a position in order to build the liquidity. Price suddenly spikes out, but we can see when we look at open interest, that liquidated people rather than inducing them to take a position. So market maker needed to drive it just a little bit further to get that open interest increasing. This move here would have triggered breakout long traders, whilst at the same time triggering anyone who went short. So similar to the previous example that we used. When we look at open interest, that green spike to the upside liquidated traders rather than induced them. So market maker had to drive price a little bit further to convince retail of the move. But the question is, were retail convinced of this move here? When we look at open interest, yes, we can see that positions were being opened. So how do we trade this? If we know that price is consolidating, open interest is decreasing and the volume is flat, this means a stop hunt is coming. Once you've seen the stop hunt, you can open a short position once the stop hunt has happened. Because you understand that this move here was a trap to induce retail to take a position out of the consolidation range to build liquidity below price. These examples show you how to use open interest and volume as leading clues and how the TBD structure confirms the intent behind the move. In both cases, the TBD system gives us the read, but you still need to be watching the open interest, volume and market structure. That's what separates traders who chase candles from traders who read the play. If the breakout doesn't run, you cut it. It's simple. You're not married to a trade, you're reading a narrative, and if the narrative changes, you exit. If you need an exchange to trade on, consider checking out Bitunix. It is non-KYC, so you can use it from pretty much anywhere in the world. Bitunix offers both spot and futures trading, and they've recently introduced an earn program, which means you can now stake your crypto to earn passive interest on it. By using the link in the description below, you'll get a lifetime 20% trading fee rebate on all of your trades. That's not just a one-time welcome bonus, it's for life. So if you're looking for a reliable exchange to trade on, check out Bitunix and make sure you use the link below to get your fee rebate. Pullbacks are one of the most powerful setups inside the TBD system because the pullback often proves the move. What that means is, if you're looking at a W or M formation, the pullback gives you the confirmation structure that the reversal is valid. For an M formation, this often shows up as a lower high, which might be a retest of the 50 EMA or revisit of a previous vector candle. For a W formation, it's typically a higher low for the same reason. When price pushes quickly and aggressively with large volume, it often forms a vector candle. This move creates imbalance. The market will then often pull back to retest that zone to rebalance some of the inefficiency left behind. The more confluence you have at a zone, the stronger the case for that entry. It helps confirm that out of all of the possible levels on your chart, this is the one worth paying attention to. This is where patience is key. It takes time for price to retrace or consolidate after a rise or drop has occurred. For example, if you're looking for a W formation, it often takes 2 full sessions to form, especially because we're not just looking for any M or W floating in the middle of nowhere, we're looking for one that forms after 3 distinct drop or rise levels. That alone is half a day gone already. Then, when rise level 1 finally happens, that move might occur over a couple of hours or longer. After that, price usually takes time to consolidate or retrace before giving us the next valid entry. So if we look at this example, it took a total of 3 days to actually give us this W formation, and after price had taken off, it took a total of roughly 20 to 24 hours before the next valid entry presented. Another indicator we use is the EMAs. The yellow one on my chart is the 50 EMA and this one here is the 200 EMA. Sometimes the EMAs will line up with your vector zones, which gives you an additional confluence. So how do we trade this? Once you find your W formation, the next step is for price to break the 50 EMA with volume and make a run to the 200 EMA, whilst at the same time breaking the center peak of the W formation. The next step is for price to then pull back, create a higher low, or go into consolidation. So now that we know that price has broken out, created new market structure and given us a new high, broken the 50 EMA with volume and made a run to the 200, and we're anticipating that price either consolidates or retraces, we want to mark out our levels below price to help us get an entry for continuation to the upside. So I'm actually going to go back to last week's price action and see where the low of the week was. The low of the week is the lowest point price went to in the previous week. So if you look at the market session times indicator from Sunday 5 p.m. New York to Sunday 5 p.m. New York, the highest point is the high of the week. The lowest point is the low of the week. So I'm just going to mark that level out because I believe that it will be relevant to this price action. So I can see the low of the week lines up with the bottom of this vector candle, and I'm going to mark out 50% of this vector candle because it looks like it might line up with the 50 EMA. If price came back to the 50 EMA and 50% of this 1 hour vector candle, it would also be a rough retest of resistance now flips support. So that's going to be an area for me to watch out for. If price drops that one, I'm going to pay attention to this one. So ideally, I want to see my pullback entry at one of these zones. So let's play this forward. Okay, so that happened fast. So price broke straight through our first area of interest. There's nothing for me to do here. but I can see that price is holding at our second area of interest. And let's just say I've missed this entry. What am I looking for? Ideally, I want to find a higher low after this point here, and we have our higher low now. I probably would have been able to get a better entry on the lower time frame, but if you were watching the 1 hour, your pullback entry would have looked like this. Now that you know how to spot and structure a high probability pullback, let's move into the final trade type, the reversal. Because this is where most traders get caught out by trying to cherry pick the top and bottom, but with the right timing and structure, it's also where some of the best opportunities show up. Reversals can be some of the most rewarding trades if you know what to look for, but without structure, they're also the easiest place to get trapped. That's why in the TBD system, we always look for 3 things. Pattern. Is this a clean M or W formation? Timing. Where are we in regards to false move week beginning, midweek reversal, or trap move Friday? Do we have an incoming news event that could trigger a reversal or push price further? And 3, the levels. Where are we in regards to the model? Are we at a key area like the high of the day, low of the day, or a prior vector zone? So let's break down this reversal pattern, which is an M formation. Before you start hunting for your M or W formation, you want to go back roughly 3 to 5 days and find the last peak formation low or peak formation high. Once you have found the most recent peak formation low or high, you want to see if you can identify a 3-day trend or 3 levels of rises or drops. If you can identify all of this, then we're off to a good start. Now, when it comes to the reversal pattern, the first thing you want to see on the first side of the M is the market maker showing up to slam the brakes on with a stopping volume candle. A stopping volume candle is a high volume candle with a large wick to the upside. From there, you let price pull away, and this forms the inside left side of an M formation. So we're not trying to cherry pick the top and jump in here. We still need to wait for more. But this is step 1 in identifying the reversal pattern. When we see large wicks to the upside or the downside, this implies that there are trapped traders within that wick. Because there are going to be traders who may have seen this as a previous resistance level, and this green candle here at rise level 3 induced them to take a position anticipating a breakout, and some people would have got FOMO. Opening along whilst this candle was still open, price then reversed on them, and now they're trapped within the wick. Before price then pulls back, creating the inside of an M formation, and then here where price is coming up to form the lower high, it doesn't quite get back to their break even, or they continue to hold because they think this is the move that's going to break right through, before we then see that lower high form and price breaks down. We're then waiting for the inside right side of the M formation to form and give us our lower high. Within this move, we want to see the market maker show up 3 times. Now I'm on the 1 hour time frame, however, you can drop down to the 15-minute time frame to identify this. And now that we are here, we can see the market maker has clearly shown up 3 times on the inside right side of the M formation. This next part isn't necessary, but it's an added bonus if we do see it. If we can see open interest rising whilst the inside right side of the M formation is forming, then this is also an indication that the market maker is inducing retail to take a position in the wrong direction before the reversal. The last thing we need to wait for is our bearish candlestick pattern, and once we have that, that is our signal to enter on the short position. Now let's go through a W formation, but a lot faster than what I've just explained this M formation. So here is our W formation, which is the pattern. The next thing we want to think about is the timing. So where are we in regards to false move week beginning, midweek reversal, trap move Friday, etc. This move here may have just been the day trade for false move week beginning. Can I see the levels within the move here? Yes, I can. It looks like we have 3 hits to the downside that came with large volume. So I just want to check the volume bar, and I can see, yes, we have 3 large spikes in volume. Do we have a stopping volume candle? Yes, we do have a stopping volume candle. However, it hasn't presented the same way as our M formation with a large wick to the downside. But if we go out to the 1 hour time frame, it is a very large wick to the downside. So yes, that ticks the box of finding a stopping volume candle. So back to the 15-minute, I've identified the first peak of our W formation. So from here, I just want to find a higher low in another session or another day. I can see that the first peak of this W formation happened during Asia and the second peak happened during the UK session. This gives me a multi-session W formation after 3 hits to the downside. If we go back to what I said about vector candles, we want to pay attention to the top, the middle and the bottom of it. So if I mark out 50% of this vector candle, more than likely that higher low formed around 50% of it. Did the market maker show up 3 times on the inside right side of our W formation? Let's have a look and drop down to the 5-minute time frame. And yes, I can see the market maker has shown up 3 times. 1, 2, 3. This gives me added confidence that this is the W I am looking for. So from here, the last thing to wait for is our bullish candlestick pattern, and we have a bullish railroad track. So the entry is off the bullish railroad track once the candle closes, with a stop loss below the first peak of the W formation. If you're loving the structure and want to learn for yourself and see it applied in real time, join us inside Trade Travel Chill. We've built a membership system that gives you access to everything we offer, from beginner courses to advanced strategy breakdown. These are the exact strategies we teach and talk about on this channel. Inside the membership, you'll get full access to course content, our daily market updates, and our custom indicators. We offer 2 types of memberships to suit your style, with business class being perfect if you prefer to learn at your own pace without any distraction, and the second option being a first class membership, which includes full community access. If you know you'll benefit from being able to ask questions, join live sessions and be part of a supportive group, then this is the one I'd recommend. So whether you like to go it alone or be part of a trading community, we've got a path for you. You can check out both options by using the link below. The more time you spend studying these setups, the breakout, pullback and reversal, the more you'll realize it's not about doing more, it's about seeing more. The clues are always there, but they only show up if you slow down and look properly. So the next time you're in front of the chart, don't rush to react. Pause, ask yourself, what is the market trying to do here? Can I see the trap? Do they need to trap? Those few questions alone can change everything.